CarMax issued a $4.8 billion warning, and almost overnight, the used car market reportedly lost up to 67% of its equity value. Picture this. You buy a used SUV, and within 48 hours, its trade-in value collapses by 2/3. Dealers panic. People relying on car equity to pay bills are suddenly underwater. This wasn't a slow slide. This was a market nuked in months by a calculated strategy. What's truly terrifying is the shadow game behind it. Strange pricing shifts, massive secret wholesale dumps, and a deliberate effort to force values down on purpose. Insiders are now saying the $4.8 billion hit is just the start. We're going to show you the hidden data, the patterns dealers won't talk about, and the one hidden financial mechanism that could make your car worth nothing tomorrow. CarMax is not just a retailer, it's the master switch for the entire used car industry. With over 240 stores, no other company moves as many vehicles or holds as much control over both the retail and the wholesale side. They are the single largest source of wholesale vehicles in the nation, running dealer-only auctions every week, moving hundreds of thousands of cars through their own pipeline. This auction block sets the ceiling and the floor for what smaller dealers will pay and what lenders will finance. When CarMax adjusts their prices or decides to shift inventory, the entire market, from the biggest banks to the smallest independent lot, feels it instantly. Their power is so immense that decisions made in one boardroom can ripple through every auction lane in the country. This means their movements are the bellwether for the entire sector. The question isn't if they can move the needle, but what happens when they decide to shove it down. But that wasn't the whole story. To understand the collapse, you have to remember how the market got sick in the first place. Back in 2021, the market flipped upside down. New car production stalled due to the semiconductor shortage, and suddenly, 2-year-old cars were appreciating in value. Buyers lined up, sometimes paying more than the original sticker price. Dealers, every single one of them, stocked up, betting the shortage would drag on. They loaded up their lots at peak prices, signing buyers to massive long-term loans. The average buyer found their loan-to-value ratio at or above 100%, meaning they had no equity from day one. For a brief moment, it felt like a safe bet, a hedge against inflation. But beneath the surface, a brutal fragility was building. The entire system was running on fumes, and when supply finally returned, the market would have to absorb all those overvalued cars. The seeds of the collapse were planted during this boom, and every dollar added to the price then was a massive risk for today. And what happened next would shock everyone. The first sign of the disaster didn't come from a dealer lot. It came from Wall Street. When CarMax dropped their second quarter numbers, Wall Street panicked. Their stock fell 20% in a single trading session, a free fall unseen since the CVD crash. The numbers were catastrophic. Retail sales down 5.4%, profits cut by nearly a third, and the average selling price falling for the first time in years. This wasn't just a bad quarter, it was a loud, terrifying signal. The phones lit up in every dealership finance office. Lenders immediately started asking hard questions about collateral. The floor had simply dropped out from under their inventory, and the fear spread quickly. CarMax $'s own auto finance chief called recent loan vintages tough, which is a terrifying code for we're bracing for massive losses. If the industry's giant can lose a fifth of its value in a single day, the message for every independent dealer and every car owner with a loan was suddenly clear. The game has fundamentally changed. The fear is rooted in one place: the CarMax Auto Finance CAF division. CarMax holds nearly $5 billion in car loans on its balance sheet. Every time a buyer drives off, they're betting the car will hold enough value to cover the debt if things go sideways. But as used car prices fall, that bet gets dangerously close to going bust. That's why the company's allowance for loan losses, their buffer for when customers stop paying, has surged to $458.7 million. This spike is a direct, chilling signal that management expects more pain ahead. They had to bump that allowance by a staggering 26.3% last quarter, mostly tied to loans written at the market's peak in 2022 and 2023. Now the cars backing those loans are worth far less than the debt. When a borrower defaults, CarMax is only recovering 35 to 40 cents on the dollar at auction after fees. That's a loss severity the company hasn't seen since the Great Recession. This massive reserve spike is a direct hit to earnings, and it signals that the loan book is the canary in the coal mine, and right now, it's screaming a warning nobody can ignore. But the real market carnage started at the auction block. Wholesale auctions are supposed to be a safety valve, but when CarMax moves thousands of units, it becomes a tidal wave. In July and August, dealers started whispering about massive CarMax blocks hitting the lanes. One auction in Atlanta listed nearly 3,000 units on a single day. The shocking part, these cars hammered at 10 to 15% below the Manheim Market Report, the industry's main pricing index. This wasn't a markdown, it was a fire sale. The immediate fallout was brutal. The Manheim Index dropped 8% in just 48 hours. Dealers who had just stocked up at higher prices saw their equity vanish overnight. Off the record, some competitors called this dumping a bomb that wiped out everyone who couldn't take the hit. When a national player can move thousands of units below the index, they are not just clearing old stock. They are deliberately resetting the entire market price with a move that feels less like inventory management and more like price weaponization. That's not a correction, that's a collapse. The most terrifying danger, though, is hidden deep in the finance structure. CarMax funds its loans through deals called asset-backed securities, ABS. These deals have tripwires, covenants that tie the whole structure to the value of the cars. A 25% drop in wholesale prices is the line where the math turns lethal. If too many loans go bad or the underlying cars lose enough value, the ABS deals fail their over-collateralization tests. Suddenly, the cash flow locks up. Money that would normally flow back to CarMax gets trapped inside the trust to pay senior investors. CarMax loses access to the residual cash it desperately counts on to fund new loans and keep the lights on. This is a cash trap written into every contract, and once the triggers are breached, it can spiral out of control, cutting off a key source of funding just as losses are accelerating. This is how a market correction becomes a systemic crisis. Price drops, breach triggers, cash traps, and liquidity dries up. It's no longer about selling cars. It's about whether the whole funding machine can survive a shock this deep. This market collapse isn't just theory or numbers on a screen. It's a tragedy playing out on the ground. Independent dealers who stocked up during the boom are now staring at six-figure losses. Imagine a dealer watching $500,000 in inventory lose $200,000 in value almost overnight. Cars they paid $30,000 for can't fetch $18,000 today. Their floor plan lenders lock their credit lines with a blunt message: your collateral isn't worth what you owe. Staff meetings turned into layoff notices. Owners are watching years of work disappear in weeks, shuttering their doors and walking away from their floor plans entirely. 8 families lose a paycheck because one auction block in Atlanta cleared at a fire sale price. This is what a market collapse looks like at the ground level, and it's all connected to the moves of the industry's top giant. The full mechanics of CarMax's wholesale strategies and their long-term effects remain partly undisclosed. What is clear is that the spiral is in motion. The loan loss reserves are spiking, the auction prices have been nuked, and the liquidity traps on billions in debt are close to tripping. The stability of the used car market now depends entirely on how quickly the industry, lenders, dealers, and regulators can adapt to shocks that no longer unfold slowly. Was this a genuine business mistake or a calculated SOB move designed to reset the playing field? You decide. So, was this $4.8 billion hit an honest mistake, or was it a calculated move to reset the market and eliminate smaller rivals? The fact is, the risk is still accelerating. The loan loss reserves are spiking, the auction fire sales continue, and those debt trap triggers are still active. The next crash might not just wipe out small dealers, it could pull the foundation out from under every car owner in America. This is exactly the kind of untold, shocking story we reveal here on Buzz Talk. What do you think? Is CarMax the villain or just a victim of a sick economy? Let us know in the comments below. And if you want to keep up with the secret financial stories and market shockwaves that the mainstream media won't touch, hit that subscribe button and ring the bell. We've got another deep dive coming next week that will expose even more untold secrets. You won't want to miss it. Thanks for watching, and we'll see you in the next talk.